Hello and welcome everyone to the week ahead commodity report for the 17th to the 21st of December 2018, presented by myself, Phil Carr, at the Gold and Silver Club. So of course today we will be looking closely at gold and oil prices as we head into another week. So last week, particularly on Friday, we really saw the US dollar start to gain momentum as we get closer to next Wednesday's FOMC statement. And this is often the case when the anticipation is that the Fed will go ahead and increase interest rates. The dollar gains momentum and it's breaking out to 19-month highs here on Friday. That puts pressure on commodities. You get a pullback on gold, silver, crude oil, and then what you want to look at is the potential for a buyback in those commodities later on in December, and particularly as we move into January as well. One point noting on gold is that it did fall to its lowest levels in more than a week on Friday. However, the commitment of traders data has shown us that hedge funds and money managers have now switched to a net long position on COMEX gold. So what that would suggest, particularly after the FOMC statement next week, is we might see a buyback here for gold, and certainly from a seasonal point of view I would watch out for that as well, not only on gold but also on silver too. We'll have a look at that shortly on the charts. Meanwhile, with oil prices, well, they dropped 2% on Friday in fairly volatile trade. Oil has been quite range bound over the last week, finding support at $50 per barrel, finding resistance at just above $53 per barrel. Hedge funds and money managers have actually now cut the bullish wagers on US crude oil to the lowest levels in more than 2 years. And we of course saw some support come in towards the beginning of December as OPEC and allies like Russia, they agreed to reduce output, but there are still concerns that the cuts may not offset the growing production, and that is causing oil to still remain quite range bound. It's moving within that 50 to 53 US dollar range at the moment, but once we get a resolution here on oil after the price has been coiling for about 3 weeks now, once we get a breakout in either direction, it will very likely lend to quite a substantial move, and that's something that you want to be able to capitalize on over the Christmas period. So with that, let's move over to the charts and I'll talk you through the key levels that we're looking at next. So first of all, if we move over to gold, gold closed on Friday at 1,238 US dollars per ounce. So it broke down towards the weekly lows, following on from the US dollar breaking out to 19-month highs here. We have seen an overall net long position increase now, with hedge funds and money managers switching to net long. Now last week gold moved within approximately 180 point range, so it attempted to break above 1,250 US dollars. We didn't get any follow through at the beginning of the week, and then we pulled back on Friday back down to 1,232 US dollars per ounce. What I would look at as we go into next week, well, first of all, we have quite an important level of previous resistance turn support, which resides around 1,236 US dollars per ounce, which is where we found some support on Friday. What I would look out for, particularly at the beginning of next week, is two major scenarios. So one of those is that gold will find support at the beginning of the week and will start to build momentum into a bull flag, and then it will build up momentum and break above this upward trending channel. So we've just had a pause in price. We'll see more follow through and therefore revisit back towards 1250, and possibly by the end of next week or into the following week, into the final week of December, we'll see follow through and a move back towards 1260 and possibly higher than that as we get into January. So that's one scenario that we could see playing out. I suspect that the real move on gold, where we could see more upside, will happen either on or after the FOMC statement next week. That's on Wednesday. Now on the flip side of that, if the US dollar continues to drive higher, bear in mind it broke out to 19-month highs on Friday, and we do have a negative close here on gold, so it's created a lower low, a lower close, and a lower high, and it has broken through some support. If gold does not get supported at the beginning of the week, then it is vulnerable to roll over, and we could see a move back down towards the next key level of support, which resides at approximately 1,230 US dollars per ounce. At that level, we've got a lot of confluencing points which come in. We've got the lower end of a trend channel, you've got the 21-day moving average, you've got the weekly pivot, previous levels of resistance turning support. So 1230 would be quite a key level, and you need to look at the ranges on gold each week as well. It's moving within approximately about a 200-point range at the moment. So within the upside and the downside, you're looking at about a $20 range at the moment, week to week on gold. So a revisit back towards $1,230. If we see that, we may not see that. Again, I would look for evidence the buyers that are coming in at that zone, and it depends at what point we would see a revisit of that level, because if it happens around the FOMC statement on Wednesday, that is where you could potentially see the buyback. If you go to have a look at previous years where the Fed have increased interest rates, that's the last couple of years, and you look at the price action, normally the low gets put in for gold around the FOMC statement, and then it's afterwards where you see a lot of the move get priced in already. So for example, traders and investors right now, they're buying the dollar in anticipation for the Fed to do a rate hike. So with that, the dollar breakout we're seeing at the moment is already getting priced into the market. So when you actually get the news delivered, it could be a case of buy the rumor, sell the news. So once the actual news is delivered that the Fed does go ahead and increase interest rates, if they do, it's not 100%, but if they do, that's where you could see the dollar start to just run out of steam and then gold get a buyback. So that would be later on next week after Wednesday. So with that in mind, what I would look at if we were to see further weakness on gold is potentially a move down to 1230. That is of quite a key level of support. If gold was to break 1230, it does open the door up to a move back down towards the lower end of the channel, the monthly pivot, which would reside between about 1215 to 1220 on gold there. That would probably be the maximum downside of the move, given that gold is moving week to week about 200-point range. So if you take 200 points off where we are at the moment, around the 1238 zone, you would be looking at the potential to revisit about $1,218. But that's only if gold found no support and continued to sell off next week. It could put the price back towards 1,220 to 1,218 US dollars per ounce. I suspect a lot of support would come in at that zone for gold. So just to summarize, what I'm looking at going into next week, there's some very common seasonal moves that we're seeing at the moment. You've had the European Central Bank announcement on Thursday. Very common to see the Friday afterwards. The US dollar picks up momentum, Euro's under pressure, gold's under pressure, silver's under pressure. We've had that normal sell-off. Now what could happen next week is we're either going to see support come in around 1235 to 1240 in a bull flag and follow through to the upside in the early part of next week and gold catch a bid even before the FOMC statement. Or on the flip side of that, the US dollar will continue to drive higher at the beginning of next week. The FOMC statement will probably be the peak of the US dollar going higher, and then at that point we could see the potential for gold to be under pressure at the beginning of the week ahead of the FOMC statement. It may retest 1230. Possible maximum downside could be about a move down to approximately 1,220, but then I would be looking at buying opportunities. The lower gold gets, the better the potential entry price for a move going into January if we see that normal buyback that occurs at the end of December and into January as well. So that's what we're looking out for on gold at the moment. So I definitely have that on your radar as we go into next week. Then moving over to crude oil. So crude oil is moving within approximately a $3 range at the moment. So last week we moved from just above 50 US dollars per barrel up to 53 US dollars per barrel. Each time oil has attempted to break out, it has not been successful in doing so. So we can see very clear trend channel at the moment, and in fact a pennant formation as well. So you've essentially got these higher lows on the chart, lower highs too. From a technical point of view, there does seem to be selling just coming in right at the 21-day moving average as well. Every time oil is attempting to break above the 21 MA, it keeps seeing a sell-off at that zone. So we keep seeing traders essentially either take profit, or we see new sell orders coming in around that zone, maintaining the price and to a certain degree suppressing the price as well below the 21-day moving average and below this downward trending channel where you've got a lot of resistance at the moment. So we are really at a point where we should get a resolution now. We're just ricocheting really between this support and resistance zones, and we're getting into the apex of the pennant here. So either way, whichever way oil breaks out next, it should be a sizable move. What I would look at going into next week is, again, we've got support here which is residing at the lower end of the channel at the moment, which is sitting at just under 50 US dollars per barrel. That is where support is at the moment, and that is where buyers are coming in to provide some key support to the price right now. You've got resistance at approximately just over 53 US dollars per barrel at the moment. So what I would look at going into next week is, first of all, if we do get some follow through to the upside and we break and close above the 21-day moving average here, that is where we could then start to pick up some momentum to the upside, particularly if we break above the weekly highs as well. Then that is where it could get a move back towards 54 to 55 US dollars per barrel. That would be the next major level of overhead resistance here. Now, hedge funds and money managers at the moment, they have cut the bullish wages on US crude oil to the lowest levels in more than 2 years. So if we see oil roll over and we start to see pressure to the downside, and if it breaks below $50 per barrel, it closed at 51.28 on Friday. So if it rolls over, breaks below $50 and $49.50 per barrel, and we close below that level as well, it does then open up the door to lower prices, which if we were to break that floor of support at approximately $49.50 to $50 per barrel, we could then start to see a move back down towards 48, and then the next really key major level of support below that would be between 47 and 45 in particular, but 47 as well. OPEC, of course, has intervened here to support prices around the current zones of $50 per barrel, but we're not seeing any follow through. So it's unusual, following on from an OPEC meeting where they have cut output, to not really see any degree of follow through in either direction, actually. So we're just consolidating here, and this is where we could get quite a big move once there is a resolution on oil here. There are still concerns about growing oil production, so it really is a case of once oil does break out in either direction, it will likely lend to a reasonable move which could continue between really now towards the end of December. From a seasonal point of view, normally oil is bullish in the last couple of weeks of December. If you go back to, for example, previous years and you have a look going back to December of 2017, this is where we were consolidating as well in the first couple of weeks of December. Then towards the last couple of weeks of December is where oil started to pick up momentum, and then from there it continued to rally throughout the month of January. We continued to follow through after it managed to break out to the upside, but it did coil as well for quite a while at the beginning of December, a little bit similar to what we're seeing at the moment in terms of price action, where we've not really got any clear direction over the last couple of weeks, and it broke out to the upside and then it moved over 900 points within about 5 to 6 weeks. So I would certainly keep an eye on oil and gold as we go into next week. Wednesday's FOMC statement could really be a catalyst for a clear direction here moving into the last couple of weeks of December. So next week you really want to be focused on that FOMC statement, and also the oil inventories data as well on Wednesday will be very important too for potentially the next breakout move here on oil as well. If you want to get access real time to the exact trades that we're taking at the Gold and Silver Club, and you want to join our community of successful traders, there's an opportunity for you to do so. It's very straightforward to make an application to become a member of the Gold and Silver Club, and you get access to the following. As a private member of the Gold and Silver Club live trading room program, you get access to the following. So you have live trade alerts. Those are delivered via WhatsApp, email and SMS. You have access to mentorship, expert advice, in-depth market analysis and trusted insights, so you can know earlier how to act quicker and maximize your return on every trade opportunity. For more information on the service, please go to www.jointhelivetradingroom.com. The link is also below this report in the description. So just click on the link, make an application, and we will of course get in touch with you ASAP. Also, make sure you subscribe to our YouTube channel. That way you're kept updated with all of the latest commodity reports.